Welcome to The Explainer. I am absolutely thrilled to have you here today. Whether you're a complete novice or you're just looking to structure your financial foundation, we're going to map out exactly how you can start taking confident financial steps this year. We're going to completely demystify the markets, and most importantly, we have to talk about the often ignored, hidden risk of simply doing nothing with your money.
Now, quick heads up before we dive in, let's set a responsible tone for our journey with a brief disclaimer. This explainer is strictly for educational and informational purposes only. It shouldn't be considered personalized financial, investment, tax, or legal advice. Investments always involve risk, including the possible loss of your principal, so always do your own research. Okay, let's dive into this. Just imagine it for a second. You go to sleep, you had to work, you go on vacation, and quietly, in the background, your money is literally working a shift of its own. Grasping this potential? It's like awakening to a completely new financial reality. Learning to invest early is hands down one of the most valuable financial skills you can ever develop.
Here is our roadmap for today. We'll cover 1. Investing basics and why. 2. Risk, returns, and assets. 3. The power of diversification. 4. Your step-by-step guide. 5. Navigating mistakes and psychology. And finally, 6. Your 30-day launch plan.
Section 1. Investing Basics and Why. Building Long-Term Wealth.
So let's look at the actual difference between saving and investing. Saving is kind of like putting your money in a highly secure vault. It is safe from being lost, for sure, but here is the catch. Inflation is like a slow leak in that vault. Over time, the cost of groceries, housing, everyday life, it all goes up, which means your carefully protected cash is actually losing purchasing power. Investing, on the other hand, means taking a measured, calculated risk with your money to generate potential returns that can actually outpace inflation. Keeping all your money in a safe bank account might feel secure today, but honestly, it's actually a massive risk to your long-term goals.
Now, what's really interesting here is the sheer power of compound growth. There is a vast difference between slow linear savings growth and exponential compound growth. Compounding is essentially earning money on the money your money already made. It's wild. When you start early and make regular contributions, even small amounts can completely snowball into massive potential wealth over decades. It literally transforms a simple linear walk into an exponential rocket ride.
Section 2. Risk, returns, and assets. The risk-return relationship.
In the investing world, there is a universal law. Higher potential returns generally demand a higher appetite for risk. Let's break down your main investment vehicles. Down at the low-risk end, you've got cash equivalents, highly safe but extremely low return. Moving to the middle, you have bonds. These are essentially loans you make to a company or a government in exchange for a steady return. And then, at the high-risk, high-return end, you have stocks and cryptocurrency. With stocks, you're literally buying a tiny slice of ownership in a business. But remember the golden rule here, folks. Past performance never, ever guarantees future results.
Now, when you enter those higher risk categories, you are absolutely going to encounter market volatility. Volatility is just the natural rate at which an investment's price moves up and down over time. Think of it like riding a roller coaster. The ups and downs, they're completely normal, expected parts of the ride. Market crashes happen, yes, but panic selling during a dip is literally like unbuckling your seatbelt in the middle of a loop. Understanding this normalcy is exactly what keeps you safely in the cart.
Section 3. The power of diversification. Reducing portfolio risk.
And this brilliantly illustrates how diversification is essentially your ultimate defense mechanism against disaster. It's the financial equivalent of the old saying, don't put all your eggs in one basket. By balancing your investments across things like index funds, bonds, real estate, and cash, you protect yourself. If one specific company or sector takes a hit, the other parts of your portfolio are right there to balance things out, heavily reducing your concentration risk.
Section 4. Your step-by-step guide, getting started safely.
All right, here is your chronological sequence to getting started responsibly. Step 1, get your financial house in order. Pay down high-interest debt and build a solid emergency fund first. Seriously, never invest money you urgently need. Next, define your short versus long-term goals. Step 2, determine your risk tolerance. Can you stomach seeing your portfolio drop 10% in a single month without losing sleep? Step 3, choose a regulated, transparent platform. Step 4, form a simple strategy.
A great one is dollar cost averaging, which just means investing a set amount regularly, totally regardless of what the market is doing. Step 5, understand the fees involved. And finally, Step 6, make that very first informed investment.
Section 5. Navigating Mistakes and Psychology. So the crucial point here is understanding the vast difference between investing and trading. Long-term investing requires patience, discipline, and diversification. It's all about letting time do the heavy lifting for you. Day trading, on the other hand, that requires active predicting, taking on really high risk, and constantly monitoring screens. I really want to reassure you here, you do not need to perfectly predict the market to build wealth. In fact, trying to predict the market is incredibly difficult, even for the pros.
You know, it's totally normal to feel a bit hesitant, and recognizing common beginner mistakes is absolutely the best way to avoid them. So many beginners dive in without an emergency fund, which ends up forcing them to sell investments at a loss if, say, their car breaks down. Others fall prey to social media FOMO, that fear of missing out, or they try to get rich quick. It's just human psychology, fear, greed, and herd mentality. Add in panic selling during temporary dips and ignoring hidden fees that quietly eat away at long-term returns, well, you can see why emotional discipline is your greatest asset.
To keep you on the right path, we have these core anchor rules. Rule 1. Understand before you invest. If you can't explain what a company or fund actually does, don't buy it. Rule 2. Don't invest urgently needed money. Rule 3. Diversify broadly. Rule 4. Think long-term. And Rule 5. Control your emotions. Selling just because prices temporarily fall is often a massive mistake. Always remember, your personal goals dictate your timeline, not today's daily news cycle.
Let's move to Section 6 and see how this builds. Your 30-day launch plan. Taking informed action. We have transformed all this theoretical advice into a beautifully structured, highly practical action plan for 2026. Just give yourself 4 weeks. Week 1. Dedicate a few hours to simply learning the basics, much like you're doing right now. Week 2. Organize your personal finances. Create a budget, track your cash flow, and get that emergency fund started. Week 3. Research platforms. You're looking for low fees, strong security, and solid customer support. And Week 4. Decide on your simple strategy, maybe a low-cost index fund, and make your very first responsible investment. You can absolutely do this.
As we wrap up today, I want you to really internalize this quote. You don't need to become a financial expert overnight. You need to understand the basics, start responsibly, stay consistent, and keep learning. Consistency and emotional discipline matter so much more than being some Wall Street genius. Focus on building long-term financial habits rather than hunting for a quick payday.
So, I'll leave you with this final provocative thought. Take a look at your own life, your own bank accounts, your own goals. What is the very first financial habit you will start building today? Will it be tracking your expenses, setting up a high-yield savings account for emergencies, or maybe finally opening that brokerage account? The path to wealth is walked one deliberate step at a time. Thank you so much for joining me on this explainer, and I absolutely cannot wait to see the incredible financial foundation you build.